We will also be looking at Fibonacci levels as one of the primary levels at which we will look for a reaction or a bounce or a response from the market as price moves throughout the day. The primary Fibonacci numbers that we are going to be looking at are showed as an example in this screenshot. For example, if we take a move from this low to this high, price has retraced 38% in this example. The other Fibonacci levels that we'll be looking at are the 50, the 62, the 79, and of course 100% retracement. The extension levels are 127% and 162% extension levels. And just as an example as to how the market responds to certain levels, in this case, we see the market comes down and makes a low. It responds quite aggressively off the low, and then it comes down and makes another attempt at the previous low, and it responds and it moves quite aggressively. We come down and bounce off the 38 retracement, which is also a previous level of resistance, becomes support, and it moves to 127% extension and this high, and then responds off of that high. Looking at this 60-minute chart is a little bit more reflective of what we're going to be seeing on a day-to-day basis. Of course, some of you may have the objective of making multiple trades throughout the day, or scalping multiple trades throughout the day. And indeed, we will look at that in further detail. But we will be using these Fibonacci levels that are placed on a 1-hour chart as some of our key levels at which we will look for a bounce. So for example, here we have this low. Price moves up to a high on this swing, so we pull our Fibonacci's from this low to this high, and our retracement levels are 38, 50, 62, 79, and 100. As price responded off the high, it retraced 38%, which also represents this high right here, and it's also essential pivot, by the way, but resistance becomes support at the 38% level, and it responds. And interestingly enough, on this downswing, it responds up to the 62% retracement level. Then price moves down to a 162% extension, and the 62% retracement of the. So ideally, we are going to be looking for the alignment of reaction levels, either one specific reaction level or an alignment of multiple reaction levels. And of those reaction levels, we will be looking for components like support resistance, trend lines, pivot levels, Fibonacci levels, or other types of levels that you may have in your own trading, little idiosyncrasies, indicators, and so forth that you prefer to use in your own trading. And what a reaction level is the way we're defining it here for the purpose of scalping. A reaction level is a level at which price may react or bounce by a move of 10 or more pips. So therefore, what we want is we want to see that price will come down and react off of this level, whether it's an independent level, just one, let's say a support resistance level, or a multitude of levels coming into alignment. So it will be an area at which we can anticipate a price bounce or response that will give us a move of 10 or more pips where we can take a little bit of money out of the market. And here we see price bouncing and bouncing and bouncing within a range, and this price level holding up. The idea is to get a picture of the alignment of multiple technical components converging at one price point, and that's an area at which we can anticipate a bounce for the opportunity to make a scalping trade.